Hi, and welcome to Aldrich Wealth's third quarter investor update and market outlook. I'm Nicole Rice, Director at Aldrich Wealth, and I'm joined by Darin Richards, our Chief Investment Officer and Partner. Darin, let's start with domestic equities. The S&P 500 logged in its highest quarter in the past 5 years, roughly. Can you talk a little bit about where this strong performance is coming late in the economic cycle?
Sure, Nicole. Let's start with where we are in the cycle. So this bull market began in 2009, and we're approaching year 10, which would make it the second longest bull market in history. So people are getting a little bit nervous about that. So we are a little long in the tooth from that regard. However, the market actually started to stabilize a little bit in 2016. Growth slowed down a little bit, earnings slowed down a little bit. And then in 2017, we had a global synchronized recovery. So the rest of the world essentially caught up with where the U.S. was. So the U.S. was doing great. The rest of the world was lagged a little bit. And in 2017, emerging markets started to grow much faster. Developed markets grew much faster. We had growth across the board. Earnings picked up. So really, the U.S. was given kind of an extra year because the global economy picked up, and that helped elevate the U.S. economy. 2018, another event happened, tax cuts. We had corporate tax cuts across the board that were huge. So we got another extension on earnings, extension on growth. So what was normally an 8-year recovery got a 9th year with the global economy picking up, and really getting a 10th year from the tax cut. So things look very, very good right now. What really propelled the equity markets higher in the third quarter was some of this was priced in. We were expecting things to be good, but things were better than expected. And really from an investment standpoint, that's really what drives the market. So we had 4.2% GDP growth in the second quarter. That was above expectations. That's the fastest we've had in 4 years. We had 27% earnings growth for the S&P 500 companies. We haven't had that since fourth quarter 2013. That was above expectations. So really the market exceeded expectations, and that's what drove equities higher. So the S&P 500 was up 7.7%, best we've seen, as you mentioned, in 5 years. And again, it was continued to be driven by the growth sectors: healthcare, technology, consumer discretionary, really the momentum sectors. So what's worked well in 2017 continues to work well in 2018. Nobody's playing defense. The interest rate sensitive sectors, real estate, basic materials, utilities continue to underperform. So the S&P put up 7.7, great performance in the quarter. Mid-cap stocks were up 5. They lagged a little bit. Earnings growth was equivalent for mid-cap stocks, but in September they pulled back a little bit. And I think that had to do with the fact that we negotiated some trade agreements with Mexico and then later with Canada. And I think the multinational large caps actually benefit more from that. And then small cap earnings were up 31% for small caps, which is fantastic, but their valuations were a little bit stretched. So we only saw a 3.6% return for small caps in the quarter. So overall, really, really strong quarter across the board. And it was really fueled by exceeding expectations. Now going into Q3, Q4, we still see pretty strong earnings expectations, 20% for Q3, 17% for Q4, kind of a slow moderation as basically wage inflation picks up, profit margins probably peaked, 4.2% GDP growth in the second quarter. Probably not going to see that again, but things still look pretty good. So really, really low unemployment, good consumer confidence, business confidence is as high as it's been in decades. So I think we'll continue to grind higher from here, but we really need to exceed expectations again to see the kind of quarter we saw in the third quarter. So I'm expecting more modest returns going forward, but still the economy looks like it's in great shape. So I would anticipate positive returns going forward.
Great, thanks. So everything looks rosy from the domestic side, as you were talking about, but now when we shift over to international, it's not quite the same picture. So international has struggled, as you know, and we've just seen the third quarter of consecutive underperformance compared to U.S. Can you talk a little bit about why we're seeing international consistently underperform U.S. as of late?
Sure. So the U.S. exceeded expectations. International didn't meet expectations. So really we had something the U.S. did well, the international didn't, and a lot of money migrated to U.S. because of that. But let's take a look at Europe, for instance. So if we look at the MSCI EFA, the International Broad Developed Market Index, it was up 1.4%. Not bad, but compared to the U.S., it was pretty poor. And for the year, it's down 1.4. So it's been a pretty rough year, as you mentioned, for international equities. 2017 was a really, really good year. We saw earnings growth jump dramatically. We saw economic growth also increase. And I think some of that was priced into 2018. And essentially, international equities haven't lived up to expectations so far this year. So Europe in particular has struggled. And there were a number of other factors. So for instance, Spanish banks have been under pressure, European banks, as the Turkish lira has dropped and Turkish debt has fallen dramatically. These banks are big holders of of Turkish debt. That's been a problem. We had the elections in Italy where we had a far left and a far right party in charge now. So the question is what's going to happen? Are they going to leave the Eurozone? They say they're not, but it added to some of the risks. The tariffs that have been put on European goods currently and potentially in the future are problematic. And the Brexit. Europe is in the process of negotiating with Great Britain, and frankly, it's not going very smoothly. So the Brexit is causing some issues. So you have slower growth, didn't meet expectations. You have these other factors that kind of overhanging the market, and performance was pretty poor for the quarter. Now, if we look at emerging markets, it was actually even worse. So emerging markets were the top performer in 2017. Earnings really took off. They were up 37%. Return for the year. Expectations were that was going to continue into 2018 as well, and similar to the developed markets, it hasn't. And there were also a couple of individual country-specific issues that really caused sentiment to decline. So Turkey was in the news quite a bit. They had too much debt. When things were good, they issued debt in US dollars. When their currency declined, it really hurt them, so their debt service became an issue. We saw the same thing in Argentina. It trickled over into South Africa. Any of these countries that were borrowing a lot, expecting growth, when growth slowed down a little bit, they were kind of behind the eight ball. So we saw some issues there. So currencies dropped, sentiment dropped. That didn't work out very well for emerging markets. And across the board, I think people sold out. And then to make matters worse, the U.S. Put tariffs on $200 billion of Chinese goods in September coming out of the United States. So we saw China sell off a little bit. It was actually the worst performing emerging market, down over 7% in the quarter. And the prospect of even additional increase in tariffs and expansion of tariffs going into 2019 put some downward pressure. So emerging markets really struggled after having a phenomenal a phenomenal year in 2017. They've been struggling so far this year, and they're actually down over 1% in the quarter. So pretty poor performance. Money fled international equities at the record pace. We haven't seen money leave international equities this fast since 2009. So generally what happens is the market overdoes things a little bit. Valuations now look fairly attractive. And if we can get any stabilization, and if they can now exceed what are now low expectations, I would anticipate things could reverse course. But for now, it's been a pretty difficult environment overseas.
Great, thank you. That was interesting. Let's transition over to fixed income. So as you know, the Fed raised interest rates again in September. It's the third time they did it this year. Markets have kind of already priced in a rate hike in December. Can you talk a little bit about this rate hike campaign that the Fed has and how that's impacting fixed income markets?
Sure. Let's take a look at the campaign first of all. So we had the recession that began in 2008. The Federal Reserve, their mandate is full employment and stable pricing. So when the recession kicked in, the unemployment rate skyrocketed, and the Fed immediately started cutting rates. They actually took short-term interest rates down to zero, so an unprecedented move to try and invigorate an economy. So what they wanted to do is make it painful for savers. You were basically getting nothing on your savings. At the same time, if you wanted to borrow, interest rates were so low that the cost of money was very cheap. So the Fed at that point is saying, we're trying to invigorate this economy, trying to get things back on track. They were actually buying longer dated treasuries and other bonds as well to push interest rates down. So the 10-year treasury got well below 2%. So really historically low levels. So the Fed was attempting to really get the economy back on track, get people not saving but actually spending money and buying assets and expanding. And it worked very well. So for several years that was the case. And then in 2016, they felt like the economy had stabilized a little bit, and they started to initially raise rates, held off again. And then in 2017, what we saw was the unemployment rate dropped to basically the lowest we've seen in multi-decades. But inflation hadn't hit their target of 2% yet. So they were fairly cautious in raising rates. And this year, inflation hit the target. The unemployment rate is extremely low, and the Fed has embarked on a slow campaign to push rates higher. They're being very cautious because the growth of the last 10 years hasn't been that fast. We haven't seen 4% GDP growth annually. We've seen 2.5. So they can really take more of a cautious approach. But what they're trying to do is slow down the economy a little bit and really head off inflation. Because if inflation picks up, as a fixed income investor, for instance, if you hold a bond that pays 2% and inflation is 3%, you're actually losing purchasing power. So the Fed is trying to head off inflation before the cheap money allows people to get too crazy and buy too many assets and things get a little bit inflated. So that's what they're doing right now. Now, it hurts fixed income investors because when rates go up, bond prices go down. However, they're doing it at a very slow pace. So if you look at the indices this year, they're slightly negative, the fixed income indices, just barely in negative territory. At the same time, as rates move higher, you and I will be able to invest at higher interest rates going forward. So it's not necessarily a great environment to be a fixed income investor currently, but at some point, things are going to neutralize a little bit. Probably next year, the Fed may stop, and then we'll be able to invest in a higher interest rate environment, and then bonds will become more attractive long term. So it's a natural progression, and the Fed is trying to be very, very cautious about raising rates, so I don't expect them to overdo it. They realize that when they raise rates too fast, too aggressively, it's led to recessions in the past. So they're being very, very cautious. But again, it's a tough environment for fixed income for now, but ultimately things will neutralize a little bit, and I think we'll see more than normal 3, 4, 5% returns going forward.
Thanks, Darin. That's really interesting. And thank you for joining us for Aldrich Wealth's third quarter investor update and market outlook.